Hey everybody, we are about to get started. I believe sound should be good, but as always, a quick sound check would help very much. Please type a quick hello on the chat box so I know that you hear me well, and that way we are ready to begin. Thank you so much. Ahmed, it's good to see you, my friend. Good to see you. And everyone else, as you are coming in, please say hi so I know that you hear me. We have 30 seconds to go, and we are basically ready to get started. $15 seconds to go. That's almost time to begin. Thank you, guys. Thank you, Joe. 5 seconds to go. It's basically time to go. Here we go. Top of the hour. Time to begin. Welcome, everyone. Today is September 15, 2022. My name is Jose Blasco. I will be taking care of the session today. Today, we are doing options trading. The session is live. If you are here now, if you are watching this recorded on YouTube, I say hi to you as well. Obviously, the sessions live are, I would say, much more useful in the sense that you could practice what we're doing, what we're learning. But definitely, if you have questions when you're watching the sessions recorded, we are here to help as well. Jeff, it's good to see you, my friend. Before we get started, we have the financial disclaimer, which I am highlighting on the upper left side of the screen. It's fairly short. It's very important, and therefore I'm counting you all to read it completely. Please do that. And as it's fully highlighted, and therefore we should have had time to read it, so I would like to highlight as well the structure of the sessions, where we normally look at the market environment first. From there, we look at the trades that we have, talk about management of the trades, which is absolutely key, especially in options trading. And from there, we'll move into planning new trades. All of this is depending on what the market has to offer and the amount of time that we have available, because we're going to be in the session for an hour. So I guess we're going to be busy today because we have some positions running, isn't it? So let's begin. Very good. So here is top, okay? And we're going to start with our market analysis. The first thing I'd like to do, I would like to look at the VIX. And the VIX is fairly easy to analyze. So let's start with the VIX, and then we'll move into other markets. And by the way, feel free at any moment in time to ask questions. So if you have any question, make sure you don't keep it to yourself. Make sure that you talk to us. Could be me, could be Boyan yesterday doing futures, could be Josip tomorrow doing options. Actually, Boyan was 2 days ago. Yesterday was Becky doing FOREX and crypto. So you guys make sure you are interactive, you are engaged, even if you're watching this recorded, so you can be helped much better. Okay. Cool. So what do we have with the VIX? The VIX is currently trading at 26.43. Give me a moment, guys. Sorry about that. I'm not sure what just happened there, but I needed to cough. Sorry about that. So the VIX is currently trading at 26 point something. So again, if we look at the graph, if I was to zoom out a bit more, this is a 55-minute time frame of the VIX. So I guess you are with me that, while there was a moment in time in June where we got to the 30 pluses, we are currently trading at 26, which, overall you could say it's, in the middle, but certainly it's much higher than the middle, isn't it? It's not exactly the middle. So we could think of options to be not super expensive in the marketplace, but certainly absolutely not cheap. And while in other trading sessions in prior weeks, we were talking about VIXs around 20 little, and I was making the point that I'd be happy to be a buyer of options. I'd be happy to be a seller of options with the VIX at the current levels, especially with a red UFO right here. So I would certainly be more inclined to be a seller of options. Okay, so no matter what we do, directional and non-directional, which will be concluded as we are looking at the S&P, certainly I would prefer to position myself as a credit trader given the level of options on the VIX. So I would like the level of options that we can find or understand thanks to the VIX, which is the implied volatility of the 500 stocks, the average implied volatility of the 500 stocks that make up for the S&P 500 index. So yeah, so that's an important thing to keep in mind. Okay. Now, of course, there are stocks at this moment in time as we speak that have very low volatility. So, of course, those stocks would not make sense to sell options. But if we find stocks that are high volatility and the VIX is not low, the two things combined gives us a better probability for the volatility of that particular single name to go down, because not only it's supposed to go down since it's high, but also because the VIX is not low, and therefore is more likely to go down. Okay, so with all of this said, we are now going to be looking at the S&P, so we can gauge and understand the market environment a bit more precisely. And if we start with the daily time frame of the VIX, so we are in a down climate, which is confirmed. And we have implied volatility of the puts above the implied volatility of the calls. So this is a scenario where being a directional trader shorting the markets, it's making a lot of sense, okay? And certainly exciting to exploit opportunities in that direction, okay? Now, I wanted to make a point, I wanted to make a comment concerning last week. When we met, I'm not fully sure about what day was that. I think it was on that particular day. I think it was the initial blue dot or something like that. So I remember making the point that either the market was blue already, I'm not sure I remember correctly, or was about to become blue. But I was also making the point that careful, implied volatility of the puts is way higher than implied volatility of the calls. So they are sellers in the marketplace. Okay, and look at the size of this down bar, not a joke. So they were sellers in the marketplace. Implied volatility told us, and while the climate was blue, it was something to be taken with caution. That's why last week we were operating non-directional trades, because we had a little bit of a contradiction when it comes to the climate compared to the implied volatility. The volatility was suggesting sellers in the market. The client was suggesting it's an up climate. So when we have a contradiction of this sort, it's certainly wise to play ranges instead of play direction, because direction is not clear, at least not with an edge. Now, today what we have is a climate which is 100% in line with what the implied volatility of the options is saying. So gray above the blue, that's sellers in the marketplace, and a confirmed down climate also is sellers in the marketplace, and therefore shorting is what makes the most sense. So I would love to find opportunities to be directional short, and I would love to find those opportunities to be credit trades, and this is the type of trades that we're going to be looking for later in the day. Okay, if there is any question, please go ahead and let me know. If there are no questions and it's all understood, certainly, even if it's a quick okay on the chat box, it's certainly very appreciated, so that way we have a conversation instead of it's only me talking, even though obviously being the guide in the session, if you wish, being your coach here. So obviously I'll do most of the talking. Okay, but certainly it's very appreciated that you are with me, even if it's a very simplistic market analysis today, because really it's very simple. Climate is red and is confirmed, and the implied volatility of puts is above the implied volatility of calls. So being directional to the short side is what carries with it the greatest level of probabilities based on auto climate and the implied volatility of the options. So this is what we're going to do. And before we look for bearish trades, okay, trades that profit when the markets fall. So we are going to be looking at the positions that we currently have and see what is it that we need to do with those positions, if anything needs to be done. The first one is Nucor. Let me go to P&L based on midpoint. I would like to first load the risk graph. Okay, so we can see what's happening to this position. Okay, here we go. We're here. Shrink it a little bit, and we can see that this position overall is producing at this moment in time, as we speak, a 69%, a $69 negative P&L. So this particular trade is currently losing a little bit of money. Okay. Now again, we still have many weeks to go until October. We have many rolls to be done. So again, this is part of the life of the trade. This is nothing strange or anything like that. It's part of the life of the trade. Okay. We're gonna talk about things that we can do to help all of this. Okay. And we're gonna talk about it right now. Okay. So option number one will bring us to the chart so we can understand better Nucor and see what happened from a directional point of view on the movement of the stock. From there, we'll move into the option chain to look at the options, and then we'll start taking decisions. Okay. Now, what do we have here? Well, we can see that we expected that stock to remain in this range. That was the idea, at least for a while, while we are selling options, and we did for multiple weeks. This trade started with a risk of $1,000 per contract. The maximum risk of this trade now is $569. So we've been massaging the trade very nicely the way we normally do with these trades, and it's all good. But notice how on yesterday trading, and actually today as well, that stock is falling relatively hard, 1.88% at the moment. So, but the day before, huge gap down, huge continuation. So that stock really received a big hit, right? So we are beyond the purple line. And being beyond the purple line, this is basically what is putting us underwater, okay? From a P&L point of view. Again, we will bring in more credit as we keep selling options. And what's going to happen is that, this line that goes all the way to here. So we'll keep bringing it up. And if in the end we end up losing, it's going to be so much less. So this is part of the trade. There is no such a thing as risk-free money in the market, and therefore this trade was indeed exposed to losing, and right now is giving us a little bit of pain. Again, it's totally normal. It's really part of the normal experience in a non-directional trade when we are exposing ourselves for multiple weeks of price movement, in this case until October 21st, while we are doing all the rolls in a weekly basis. So I am absolutely not concerned about what's happening here. It's basically a normal thing to happen, okay? Now, what can we do? Okay, what can we do? What's the normal thing that we need to do? Well, the first thing that we need to do is we need to explore if they are distorted Greeks or not, so we can continue with our rolls, okay? And that's the first thing we need to do. In other words, forget about what the stock has done. Let's see if we got distorted Greeks, because if we got distorted Greeks, it's time to roll. So we got September 16 and 23. The strikes that we are using here, if I am not mistaken, was the 125 and the 150. So I'm gonna look at 125. We don't need at the money, and the 150. And if we were to deal with those options right now, so if we started with the 150, so the 150 is providing 3 cents of premium, and there is no theta, so obviously the calls are distorted, so rolling the calls will make a lot of sense, okay? Even though I'll make a point about that in a moment. And if we were to look at the puts, okay, if we were to look at the puts, so on the put side, we got the bid and the ask is 7 to 655, so let's call it, almost $7. It's the premium that those options imply. If we look at theta, we got no theta value, which also tells us the Greeks are distorted. Okay, so the idea here would be to get rid of the puts that expire next Friday and sell the next puts, which we should be able to get at 780. So buy them back at 7, sell them at 780. That's gonna drop. That's gonna reduce the risk of the trade by 80 cents. Okay, so that's a no-brainer. Okay, that's a no-brainer. And we're gonna do it right now. Okay, in both cases we will need to roll. Okay, so let's go ahead and perform the rolls. Okay, I'll start with the put side first. So if I look at new core and we look at the put side right here, 125 put expiring on September 16. If I right click and create a rolling order and I roll 16 of September to 23 of September, same strike, same type of unit, 125 put. This is supposed to bring in $100 of credit, which is going to reduce the risk by $100. So instead of $569 of risk, we're going to have less. Okay. So let me see the working order here. So here's the working order on new core. Let's see if we get filled. Let me see the questions on the chat box while I'm waiting to get filled here. So, Joe, I get you. The unfavorable earnings forecast came out. This is not a bad thing, to be honest, okay, because that rises the levels of implied volatility. So that's how I'm getting $100 on this. If the stock was just moving down, but there was no reason for it, if you wish, probably the volatility will not rise as much. And instead of $100, maybe I'll get, 55. So that's not necessarily a bad thing. And, from a price movement point of view, You can see it's a very violent move. So when moves fast in one direction, often moves fast in the opposite direction. We got UFOs below price, isn't it? So we may get that stock back in the range very quickly. And in the meantime, we collected $100, which reduced the risk by 100. And next week we do it again, right? So again, it's part of the normal process of the trade. And it's certainly something that we see often when we execute this type of trade. So nothing strange, nothing to be concerned about. Joanne, how are you, Joanne? It's good to see you. Yes. I hear you. I see your comments there in the chat box. Yeah, agreed. So back to top here. Okay, so actually I did not get filled. So let me try to get this for a little less. I'm going to replace it. Let's see if we can get 95. Confirm and send. See if we get it. If I don't get it, again, I'm going to push it hard quickly because we have work to do, and I want to spend time with trades instead of order execution, even though this is absolutely critical if you're doing this for yourself at home or in an office or wherever you do it. Make sure you get good executions. Okay, we just got filled at 95. Okay, so we got 95 cents. Okay, we got 95 cents, and therefore let's go ahead and edit the spread we have, where the put side was moved from September 16 to September 23, which is now equivalent to saying that instead of 306, we got 95 cents. So that is 401. Okay. So in other words, right now, if I click OK, we will see a different risk profile, but we can see as well that our total risk now is 474, which is $95 less than what we had before. So the management of the trade is doing its thing, reducing the risk the way we want it. Okay. Now, what about the call side? Okay. And here today, I would like to add a bit more because again, there is so much to teach when it comes to options, and many times, it's difficult in a 1 hour session to show everything we need to show, and sometimes we keep it simple, which simple is good, but options give us the opportunity to do beyond simple as well. So I want to explore a couple of choices, right? So choice number one that we normally do is roll the call, right? So rolling the call with new core would be done like this. So here's the 150 call that expires in September 16. You will right click, create a rolling order. Here we go. And once you do that, now this roll seems that it's going to bring in 9 cents of credit. So you probably remember from many other sessions before that when something like that happens, the approach would be forget about it. So what we're going to do is that we're going to place an order using September 23 with the 150 call. I went too far. Okay, 150 call. And I'm going to make a limit order to be 15 cents. Okay. And this is going to be a good till cancel order, but I'm going to use an activation rule to send this call on Monday only. That way, I don't roll my current September 16 call. I do not roll it. I let it fully expire. And once it's fully expired, so in other words, I collect those extra 2 to 3 cents and I don't pay commission for it because I let it expire. So then on Monday, right when the market opens, I'm just going to do it again, send that order for 15 cents. And, 2 or 3 cents plus 15 cents is like 18, which is way more than 9 cents, which is what I will get if I do it now. So this is the action that you have seen me do in prior weeks. So I guess I can talk about it quickly and I don't need to demonstrate. If I'm wrong and you want me to explain it or do it, please let me know. Because what I would like to do now is I would like to give you another possibility, a different possibility. Okay. So what is the other possibility I would like to show you? Well, and again, we're going to have to compare spreads to evaluate if that would help or not. Okay. So option number one is take the 150 call, make it September 23, and then you got 15 cents extra, which that would be 305. Okay, so this is assuming, let's say I'm going to get filled on Monday and I get 15 cents. So that would be, the new risk graph that would look like that, and that would reduce my risk all the way to 459. Okay, so we keep shaving on that risk. Okay, so that would be absolutely correct, and that would be a valid action based on what we've done before. But I want to add a third choice. Okay, I want to add a third choice. And the third choice is going to give us a little bit more analysis and work to do, but it potentially is going to be much better, because what's the issue? Well, the issue is that, again, if we look at the option chain and we look at the 150 call, well, it's so far away that, first of all, there is no bid. So for us to get filled and we want to sell it, we're going to have to lower the price a lot to get filled, because no one is willing to buy that call, right? So, I mean, on Monday, maybe yes. So then thank you very much, market, but it's going to be a tough one. And we've seen that before. When those options, when those strikes are very far away because the underlying has moved by a lot, by too much, so then the trades become less efficient when it comes to shaving the risk. I'm getting $100, $95 of shaved risk on the put side, but then we get only 15 on the call side. And why? Well, because the distance from the call to the current price is a lot compared to the distance from the current price to the put, which is much less. Okay, that's the issue. Okay, so what can I do? Okay, what can I do? Well, I could do something similar to we do with Aaron Condors, which is looking at what's going to happen based on statistics on the expiration date, which is here, when it comes to what the new price range should be, which would be here, right? And if we were to look at that, okay, so if we were to look at that, okay, right here, if we were to look at that, and we need to find UFOs now. So I'm dropping to the 55-minute time frame to see what's available. So we got many UFOs, okay, and I have one here. Okay, there are 49.76% probability. That's fine because it's non-directional trading. So 48% or more, I'll take it. So if I go here, I got 2 UFOs or more, and I got the purple line. So that is located at 145 something. So if I look at the option chain and I highlight 145, right? So what happens? Well, typically, I mean, I'm not sure yet, but typically you would get a better level of liquidity. And this is really funny because the liquidity here shows very, very weak. Right? It looks like we only got 14 cents of liquidity. So this looks very, very weak from a liquidity point of view. Okay. But anyway, I'm going to simulate it so you see it. It doesn't look like we're going to take it, but I'm going to simulate it. So the question is, what if I edited that spread? Okay. And what I want to do is I want to get rid of the whole call side. So the call side is 150. What if I bring everything down to 145? What would happen? What would be the consequence? How would everything change? Right? So the first thing I want to do is using calls, right? I'm going to add 2 legs with the 150 strike. 150. So one is going to be October 21st. One is going to be September 16. September 16, I'm going to buy it. October 21st, I'm going to sell it. So doing that, it's equivalent to closing the calls. So I'm selling the 150 that expires in October, which is the one I bought that expires in October. So if I sell what I bought at the current price, it's equivalent to I close the call. And same thing for the September 16, which I sold. So I am now buying it back. That's the September 16 at the current price. So that's equivalent to closing the calls. So if I perform this action and I click OK, you're going to see that now what I have is, a trade that looks like that. Okay. It's look at the one which is the let me say this correctly, the fuchsia. I could not say it. I don't know why. So this would be the new trade. Okay. And it would certainly look powerful, but at the same time, if that stock keeps falling, so I'm gonna lose up to 525, which 525 it's more than 459, right? So I don't want to add risk. I want to reduce risk. Okay, so what else can I do? Well, let's see. So if I was to do this, And again, it's not going to look good given the prices I saw before. But just so you see it, if I add 2 more legs, oh, wait a moment, I got the 120 here. That was a mistake. Okay, let me redo it so we can see it, because I got the 120, so obviously that was very bad. Okay, good. That looks a bit more reasonable now. Okay, so notice that if I did this trade the way it is now, so I'm reducing the risk a bit more, but I don't have any green zone. Remember, every time we do rolls or tweaks, we are looking for 2 things: reducing risk and giving the trade a second chance. In this case, we are reducing risk by a bit, but we are not giving the trade a second chance. There is no green above the fuchsia line, or I should say below the fuchsia line. So that action by itself and stopping there is not good enough. Again, that was not my plan. My plan was to get rid of the 150 and then to add the 145. So this is getting rid of the 150 and you are left with the puts only. Now let's add the calls again, but let's make the calls to be 145. September 23, October 21st, sell the 145, buy the 145. So I'm covering this slowly. I am now buying the October 145 call to substitute the 150 call I had, and I am now selling the 145 call that expires in September 23 to substitute the September 16, which I want to substitute using September 23. Right? So by doing that, again, it's not going to look too good because of the premium levels I saw before. But now we get a chart of that sort. Okay, and because the levels of premium we've got before, notice I will not accept this. Okay, because we are back in a situation where we are rising the risk. Okay, from 474, which is our current risk, we are making it 493. So I would not take it. But notice how a new green zone appears, right? And the reactivity to an increase in implied volatility would also be there. So this could be a tweak. I mean, if I had done that yesterday, it would be great, actually. That would have been a wise action to do yesterday. And I say yesterday because yesterday, that's when the market moved so much. So before it moved that much, in the middle of the day, you could have done this and it would have been much better. But today, the market went another 2% down, with Nucor. So the 145 strike, it's not giving us premium enough. Not only not premium enough, not even liquidity. We have no bid on the 145 strike on September 23. So that's why this looks quite weak. Okay, that's the reason why. But again, when price was closer to 145, so you may have had a good shot at doing a tweak of this sort. So notice that by doing that, I could have produced a better outcome, which is not the case today. So I'm going to do the normal type of roll, which is going to be leave the call alone and sell it on Monday only. So I'm going to do the normal thing. But if you had managed this a bit more actively into yesterday, you could have created a better effect. Okay, so instead of, let's say, getting paid on those options, right, where the 145 call we sold pays us 8 cents. Let's say instead of 8 cents, we were paid, 30 cents or 35 cents. And the other one, instead of 78, cost us, let's say 85. So next thing you know, now you will be in a situation where the risk, it's more or less the same. Okay, the risk is more or less the same. But because everything is closer to price, so if that stock keeps falling down, the future rolls will work better on the call side than the current rolls that are not working well because the 150 strike is too far away, where the 145 is obviously closer. Okay, so this could certainly be something that you could do in that particular case. Joe, butterflying it, it's indeed an option that could be applied as well, but you are not going to get much from it because for you to butterfly it, you need to sell another call, right? And the calls are paying us, the roll was 9 cents, right? So you do a butterfly and you're going to get nothing for it. So again, you need to be closer to 150 to be able to do anything to 150 and have a positive effect. This is like when I remember in prior sessions we had cases where we rolled units on an iron condor, and because we only meet once a week, right? And sometimes the stock went so far, and then my rolls were terrible, where some of you got pretty okay rolls, and the reason is because when you did the roll, price was closer, right? So this is the same case. So your idea of butterflying certainly makes sense from a theoretical point of view. Good thought, good thinking. But from a practical point of view on how much premium you're going to get, it's going to be disappointing in most of the cases, okay? Unless you have a case of extreme high implied volatility and you have some price distortion, some price anomaly on that strike, okay? Anyway, so now, one last comment related to this, which is important in case you ever do this, okay? In case you ever do this, okay? One comment is that, okay, so if you ever do this and then the stock goes back up, what's the danger? Well, the danger now is that you may surpass the new purple line, which is closer. Because being closer, the probability of surpassing is higher, even though probabilities suggest it's not going to happen until the expiration date. But of course, we've seen that calculation to serve very well as a reference, but it's not, it's not a wall. Price could surpass that calculation, correct? So what I'm trying to say is that if you do this type of tweak, now you have to be active on the management, and you will probably not wait for the earnings reports. If the stock was to come back higher and gets more or less closer to the midpoint, which is going to be somewhere in here, right? You would see that P&L go up. You can see the dotted line. It will go up to, let's say, $250. And that is like 2-3 times what we've seen as a P&L of this trade since the trade started. So you would just close the trade for that profit and forget about it. Because again, the price to pay to make the range smaller is that the probability of breaking the range is higher. And since we need to wait all the way to the expiration, to the earnings date for that, that becomes now a hopeful situation where you hope the range not to be broken. Is that making sense? So so the idea would be just wait for a bounce, and when the stock goes back to somewhere, in this case it would be 147 something or something like that. So then you would just close the trade, and it would be $250 of profit. Great, you take it, you're on, done. But and that would be a valid management. But again, I cannot do it today because I basically get nothing for the call side. Okay, cool. So let me do the normal roll, and then I'll look at your other comments on the chat box. I see a few more. Let me know, by the way, if what I have explained is making sense to everybody. So I am placing an order to be submitted on Monday 19, and that would be 9 something in the morning, and 9:32, good enough. So save, good till cancel, sell the 150 call that expires September 23 with a limit order, 15 cents minimum, good till cancel, correct. Okay, so we're just going to place this order. That order is going to stay there, will be activated on Monday. And if the stock rallies, we make it filled. If the stock does not rally, then we won't. Okay, and that's it. So that's all for the management of Nucor for this week. For sure, the trade will last until October 21st, so we'll keep talking about it in the following weeks. Okay, good. So take a look at the chat box so I don't miss anything. Mark, you got 105. This is great, much better than me. Butterfly call side, I saw that, Joe, and we talked about it. Joanne, thanks for explaining. My pleasure. Joe, let the September 16 expire and place the butterfly short calls lower on the Monday. Yeah, that's also a valid possibility, and that would be a bit more beneficial. But at the same time, the downside of doing the butterfly is that you will be capping the vega of this trade to basically half. And now if you have an extra increase in implied volatility as we are approaching earnings, you will not capture that. Okay, you will not capture that. You will capture much less. So instead of doing the butterfly where you're going to get very little, and then it's 4 units, which is a lot of commissions. So I think that a more practical approach is what I explained today, which is narrowing the range. So you narrow the range, you get more premium, you can do it sooner. You are still exposed to an increase of vega, but now if the stock goes back up very quickly, very fast, and it gets to the midpoint of the new range, you have to get out, because then you would have a problem if the range breaks again. Okay, so again, Joe, I believe that my approach is just a bit more convenient, more practical, and also if you are dealing with a stock that is not that liquid, less options, also less slippage. So I guess that you get my point. Okay, cool. In any case, love the thinking, very good thinking, very reasonable thinking, very smart, and it would make sense. What you said is definitely valid. So I'm just gonna copy the new position we have on Nucor. I'm just gonna add it to the continuation of the life of this trade right here. Okay, and we are now gonna look at Lennar Corporation, which is the next one in the list. Okay, and we have lots of things to talk about Lennar Corporation, because when you look at the chart, if I'm not mistaken, I think it's Lennar. Yes, exactly. That was the one. So notice what happened yesterday, right? Yesterday we hit the purple line on that stock. So what are we supposed to do when we hit the purple line? You guys tell me. What are we supposed to do when we hit the purple line on Lennar Corporation? Please let me know. In the meantime, I will load the risk graph so we can take a look at what's happening to the stock as we speak. And we can talk about tweaks and options. But I am going to be looking at the chat box for you guys to confirm to me, what do we do when we hit the purple line? Good job, Joe, as well. I see your comment on rolling on Tuesday. So you were on top of it, and I guess you either saw the big movements or you saw the Greeks getting distorted and you just acted on it. Okay, so well done. And that's obviously the way to do it. Okay, obviously in the session, since we meet once a week, I do my best to do what I can do. But obviously, if something happened or some action had to be taken 1, 2, 3 days ago, obviously it's not possible. So Jeff says that we roll the call down. Okay, we roll the call down. So this is answer number 1. But we are more people in the session. Okay, guys. So please be generous with me, and you don't have to have it right. And you know this chat is private, so only us see us. Okay, meaning that the ones watching this recorded will not see the chat. So you guys feel free to type. If it's wrong, it's fine. We're here to learn. There is no reason to not to type. Okay, we are here to learn. So what do we do when we hit the purple line? That's the question. Okay, because I'm going to give you the answer in just a sec. If we go back to what was last Thursday when we met, that was on the 8th. Okay, so the 8th is right here. Okay, good. So the 8th is, or the 8th I should say was here, right? So on the 8th, the probability lines were crossing the purple line, but it was after the expiration, so no problem. Nothing to be done on that day, and we did not act on Lennar Corporation that day. What about the next day? Well, even less, right? It did not. It crossed the purple line below, but way after the expiration date, and above also it crossed the purple line, but is also after the expiration date. So nothing to do here. What about the next day? Right? Well, the next day, obviously, we crossed all the way. So the next day, the action to be taken, okay, that was yesterday, would have been to draw a line here, okay, draw a line, okay, and go find out if there are UFOs and roll the 85 to become the 77.5 or the 80 or something like that, and roll it and make another profit on the call side and get another set of premium with the calls that are closer to price. Okay, so that was sorry, I said yesterday, that was 2 days ago. Now, yesterday, beyond this graph showing the same thing, right, which is the fact that we are crossing the bottom purple line, and you can go ahead now and just draw another red line here and roll the calls again. Beyond that fact, the reality is that not only we crossed the purple line with the probability cone, but actually price action itself crossed the probability line, right? So at that moment in time, it's time to do what? Okay. And I don't see the answer on the chat box. Hey guys, what happened? At the moment in time, we butterfly it. That's the answer, right? So this trade is made of, let me compare spreads and copy it, right? So this trade is made of 93, 94, because in my case, I never rolled, okay? It should be 86, 84, 85, okay? But in my case, I still have the 90s. So 94, 93, that's what I have. And on the put side is made of 74, 75. So let me write it down on the screen just to be as visual as I can. So we should be in a trade which is long 86, short 85. And then we should be in a trade where we also have the short 75 put and the long 74 put, okay? So butterflying it means that not only we roll the calls down, rolling the calls down means we close them and we move them down, but how low they go, it's not going to be, give me a second, my mouse just got frozen for whatever mysterious reason. This is not fun. My keyboard and my mouse just got frozen. You guys hear me? Can you please confirm you hear me? Okay, give me a second. Okay, now, mysteries of technology. So instead of rolling the calls down to this price level, butterflying it means that we need to align the short call with the short put, and then we get a call above. So therefore, we would need to construct a position of this sort, which is 76, 75, 75, 74. That's butterflying it, which is it's still rolling the calls from 85 to 75, right? So it's still rolling it $10 down. But the key is that the short strikes are the same. That's why this is not called a condor anymore. This is now called a butterfly because of that reason. Okay, so now we'll see how it goes for me, because obviously we have 1 day to expiration. This should have been done yesterday. So we'll see. But again, I'm gonna try to do the same exercise. I'm gonna go with the mid. I'm gonna emulate and see what happens if I sell the 94 and buy back the 93, and then I buy the 76 and I sell the 75. So if I do all of this, basically I'm closing my calls above and I'm selling the new calls below, which is 76, 75. And if I do that, so now we have a totally different risk profile. Let me maximize this, okay? Different risk profile where the maximum we can lose now has been basically diminished by 2. I mean, and if you've done all the rolls that need to be done in this trade may be breaking even, guys, okay? This trade would lose like, I don't know, $10. You would probably lose more on the commissions than what the trade would lose, because this trade had gone through multiple rolls. I didn't do any, so if I do it, I'm shaving the risk by half, which is good enough. But if you did the whole process of this trade, I would say probably this trade doesn't lose money. Okay, maybe you even locked in some profit. And in any case, it's the right approach, because notice how we reduce the risk by half from 90 to 57.5, and we give the trade a second chance. We still an open green area inside our orange triangle. Now, of course, the new break-evens are different. Okay, the new break-evens are different. So now the profits would take place between 75 and 74. Before, the profits would be from 93 to 74. So now the whole thing has been moved down to 74, 63 to 75, 38. So same story. Current price of the stock is here, which is 74.28. So if the stock rallies 50 cents, $1, and gets into the green zone, you know, you could consider getting out of the trade, even though you may not be able to, because the expiration is tomorrow and many of those strikes may start lacking liquidity soon. But basically you're in a good position, which is you either make up to 62.5 or you lose a maximum. Sorry, you either make 37.5 or you lose a maximum of 62.5 as we speak, because the prices have moved and now it's showing 62 instead of 57. Okay, So this would be the butterfly that we would have done, that we would have needed to be done. The way this is done, let me show you, even though I may not get filled because I still have on Lenar Corporation, I still have the 93, 94 call, which are so far away, which there must be no liquidity at all there. So I may not get anything. But anyway, let's try. So I'm just gonna roll those. Okay, and to roll those, basically, I am using 16, and I want to use 16 as well. And what I want to do is I want to sell the 75 and sell and buy the 76. Okay, so by doing that, it shows that we're gonna get 32 cents of credit. So I'm just gonna go for it. But again, I'm not sure I'm gonna get filled given the lack of liquidity on the 90s. Okay, I'll leave it there for a little bit, and if any, I'll push it later just to get it filled so we can document it. Okay, but obviously it's gonna be a tough one with expiration being tomorrow, 93, 94. I'm gonna have like zero liquidity, right? So it's gonna be very difficult. It's too late for me. Okay, I should have done, look at that, 1, 2, 3, 4, 5, 6 rolls, and then the butterfly. So if you had done all of this, again, this trade is probably a lock-in profit, right? Or a tiny, minuscule loss, okay? Anyone has been doing all of this during the trade, during all these lives of this trade? Let me know in the chat box. Mark, you could not get filled on the calls, so I just have the put left. Which trade are you talking about? Are you talking about the Lenar Corporation? Because if that's the case, that's confusing to me, Mark. If you could not get filled on the calls, how come you don't have calls? It's confusing to me. So if you could confirm that, that would be great. Ahmed, sometimes we cannot roll over. What should we do? What do you mean we cannot roll over? You mean like because maybe that day, you were not feeling well and you were in bed, or you were traveling that day, or you mean because you tried to place an order and you were not being filled? Let me know what's the case. Mark, in Lenar Corporation. So how come if you did not get filled on the calls, you only have puts? I don't understand that, Mark, because you have calls from the beginning of the trade. So if you did not get filled on the calls, you should still have the calls. Jeff, rolled 3 times on the Lenar call so far. Good job. Okay, Ahmed. So you placed the order and you did not get filled. Okay, so if you place an order and you did not get filled, you need to keep massaging that order, trying to get a little bit of a less beneficial price point, but you should try to do the roll. Because if you don't do the roll and the market keeps moving away from you, well, if you did not get filled today, tomorrow is going to be even more difficult to get filled because price is further away, making the strike to be deeper out of the money. And on top of that, one more day of time has passed. So you are closer to expiration, which may start lowering the volumes that are being traded on that expiration cycle too. So it's important that when it's time to roll, you make sure you roll. And again, if you go for the midpoint, you don't get filled, you need to try a bit less. And if you don't get filled, you need to try a bit less. If you don't get filled, you need to try a bit less. If you really don't get filled, you call the trade desk of your broker and tell them, hey, what can I do? Can you guys help me? What do you guys see something? Is my order stuck in an exchange? Because brokers have depending on the brokers, but they have different ways on how to route orders, especially since we are in the era of payment for order flow. So many brokers will send your order to one exchange only. And maybe you could get filled if your order was exposed to other exchanges, but maybe they send the order to the Miami exchange, and nothing against the Miami exchange, but maybe there was more liquidity on the CBOE, for example, and the order was not sent there. So you wouldn't get that much visibility from your platform, but if you call the trade desk, they may help you to push the order to another exchange. And then you get filled, or you may request that. It's like, hey, help me, So, but yeah, in the end, if you don't get filled, probably it's lack of liquidity, and then you have to give up on a little bit of premium. Okay, so that needs to be done. You did the butterfly, very good. So what is your overall risk for the trade now, Jeff, with all those tweaks? Okay, did you measure it, because you've done multiple rolls and now the butterfly? So what is your overall risk? Mark, because we allowed to expire and then we could not be feeling next week. Well, but Mark, I believe you are confused with the Nucor trade, which is a double diagonal where we are rolling every week. With Lennar Corporation, it's an iron condor where all strikes are September 16. There is no rolling. We are rolling because price is moving away from the range. We are not rolling on a weekly basis because all options belong to the same expiration date. It's not a double calendar. It's an iron condor. So keep that in mind, Mark, okay? It's a different case. I believe I missed a question from Joe. Yes, Joe, I don't want to take up any more time about Nucor, but I meant putting on a diagonal butterfly, if there is such a thing. In any case, it would be let me think about it. I don't think there's a term for it, but it would be if I was to pick up a term, it would be a semi-reverse diagonal butterfly. Semi because one of the units would be longer term, the other ones would be shorter term, and you would be using you would not be using same expiration date for everything, right? So because of that, which is the concept of diagonal, so then you would get a little bit of data but less. Okay, so it's not as straightforward. So we can certainly look into things like that in another session. Maybe, Joe, we are doing sharpening on Saturday. If you'd like to come with that question, then maybe we can discuss it there. But that's something that we will need to take, kind of like from zero and look at it separately because it's a totally different approach, okay? But still, what I said before about the quantity of units applies, okay? So my approach is more pragmatic. I'm not saying I am the king of the markets. I'm just one trader. Okay, there are millions of traders. Okay, so we gotta stay humble, but at the same time, from a pragmatic approach point of view, I'm using less units than you. I'm gonna get less slippage than you. I'm gonna pay less commissions than you, and I'm gonna get more Vega than you, which is the ultimate bet of this trade, the way it's constructed. So I believe my approach is probably more efficient because of all of those reasons. Okay, but again, there may be cases where maybe it's worth it to explore in both cases. Like, for example, I'm having terrible liquidity on the 145 strike earlier, isn't it? So maybe, okay, so if 145 strike has zero liquidity, maybe you go all the way to October 21st and you do butterfly the call side, and maybe you end up with something a bit more intelligent. Could be, okay, it could be. But yeah, we can talk about that on Saturday, okay? Cool. Okay, so yeah, so that's it for this trade with Lennar Corporation. This trade completes tomorrow. So again, as long as we end up somewhere between 75 something and 74 something, okay, as long as we end up somewhere in that new square I just put in here, so the trade will be profitable. If we end up outside that, then we won't be profitable, but we're going to lose less than half of what we have. Cool. Next one. Wow, so much to discuss, guys. It's already 7 minutes away from the top of the hour. So we have IBM. Wait a moment. Well, I didn't copy the trade, but it doesn't matter. It expires tomorrow, so that's it. You know what? I'm just gonna delete Lennar Corporation. Done. And then IBM. Okay, IBM and Amazon. So let's take a look at the risk graph. Okay, so here's IBM. So IBM is another iron condor. To be honest, that one we're gonna have a very easy conversation here. So this trade is just working according to plan. There is nothing strange. Okay, so IBM is inside the range. Okay, and the crossover, it's happening after the expiration. So far there is nothing to be done. Now, sure is that IBM is falling hard. So if it keeps falling hard, then we're gonna have to start, rolling the calls, right, down, to maintain and massage the trade the way we do it. So far, there is nothing to be done. And this trade is actually showing a minor profit here, $3.5. But again, it's all working well according to plan. So nothing to be done on IBM. And with Amazon is another double diagonal, double calendar, I should say. I don't know why I always say double diagonal. It's I guess it's bad muscle memory. So this trade is showing a little bit of a positive P&L at the moment. Amazon. Let me take a look at this question mark. Remember, the roll could not be done because of the strikes were in conflict, so I had to close the calls. Then, when I attempted to sell the call vertical, I could not get filled for 15. Oh, got you. I understand. So you had to do it in 2 steps, and you completed the first step, and then you could not do the second step. Okay, great. Well, you know what? Simple. Just sell a credit spread today. You can do the 76.75 credit spread, and basically you are adding the butterfly portion to your put side. Okay, that you can do it. Okay, not a problem. You could actually have tried in, if I go back to Lennar Corporation. So you go back to the chart. So let's say you had the 90.89 and you wanted to sell 87.86, but you were not able to get filled on the whole thing, and you managed to get rid of those, and then as you try to get filled on those, it didn't happen. So what do? You try next day, and if it doesn't happen, you try next day again, and if it doesn't happen, it's because the stock is moving very badly. So then the next day you try this one until you get filled, and you should have got any of those, right? Now let's say you tell me, look, it's just been like crazy. I just didn't manage to get filled at all. Okay, so today, or actually I should say yesterday, what were you supposed to do yesterday? Butterfly it, right? And butterfly means selling the 75 and buying the 76. So you don't need to have calls to add the butterfly slide. You have the put side, 75, 74. Anytime you could add the call side, 75, 76, and now you have a butterfly because you already got rid of the calls before. So you could add those new calls any other time. By doing that, you don't increase the risk of the trade. You decrease the risk of the trade by the amount of premium collected by the call side. Yeah, I get you, Mark. I get you. I'm just saying, okay? I'm just saying that this is something that you could have done. So you guys think about it. Again, I'm always thinking that, when I'm running the session, of course, I'm trying to demonstrate visually what to be done, but I also like to use words to explain what to be done. So when I'm not demonstrating it live in the sessions, you guys, know what's the next step. Okay, and the next one is Amazon. Amazon is doing a good job. He's in the middle of the range. He's doing his thing. Things are normal. And we may be dealing with distorted grays, which I bet we are. So let's go ahead and take a look at those. We are dealing with the 139 and the 121 strike. So let's get the option chain on Amazon. Let's look at 16 and 23. Let's look at one strike. And we are talking about 121 and 139. And if we start with the call side, which is the 139, so we got 3 cents, theta is 9 cents, no way, the calls are distorted. If we look at the put side, the 121 is 18 cents, theta is 34 cents, not possible to make 34 cents a day when the only thing left is 18. So it's time to roll. It's time to roll both the call and the put. So let's do it. So I'm bringing Amazon here. Let me place the orders quickly and then I look at the chat box again. So we are rolling the 125 put from 16 to 23. That will bring in $108 of credit if we get the midpoint. And I also want to roll the call side. That's it, we got it. And I also want to roll the call side. So create a rolling order. 139 call to 139. That's going to bring in only 28 because we are further away from the call side. But again, this is valid. So we are just going to do it. Okay, let's see if we get filled. I mean, you would expect it to take a bit longer to get filled because of what I just said. Okay, let's see if I can get filled so we can document this. Okay, chat box, Jose, with the iron butterfly, how do you exit the trade? It's either manually when the stock comes closer to the midpoint of the butterfly, which is 75. You just close the trade for a smaller P&L, or you just leave it alone all the way until it expires. And it's either you are going to be losing the whole amount, or you're going to be making whatever amount is left, depending on where you end up in the middle of the butterfly. Now, it's important that you track it. We commented that in prior sessions because you may get assigned but not exercised, and therefore on Monday you may get stuck. Okay, so it's important that you track it so you don't get in trouble in this way. In any case, on Saturday when we do sharpening, I'll be doing sharpening this Saturday. I'll be doing sharpening on Saturday, and Sunday I'll do top. Okay, so this week I'm keeping myself a bit busy. So if you join me on that session, we can talk about it because we're out of time at this moment. Okay, but we just completed the rolls. We got 25 and 122. So let's document this. Let's document it. So compare spread, copy primary, edit. So we move the September 16 to September 23 and September 16 to September 23, correct. Now on the call side, we got 25, so 25 and 29, that is 54. And on the put side, we got 122, which 122 plus 76, that is, that's easy math, but for whatever reason, I'm getting confused. That's 198. Here we go. So we got 198,054, and if I click OK, so this is the new risk profile in orange color, where you can see we went from a risk of 795 to 648. And again, we are doing what we are doing with these kind of trades, right? It's kind of like the beginning of the trade with Nucor, but we are doing this with Amazon in this particular case, and this is valid, and it's a simple roll for both the call and the put side. Nothing too complicated to comment. So I'm just gonna paste it after Amazon, so we have it there for future sessions. My friends, we surpassed the ending time of the session, so I'll stop it here. Thank you so much for joining me, guys. It's a pleasure. I will see you on the Saturday on the sharpening if you can make it. If not, if you have questions but you cannot make it, shoot an email to me directly, so I will take your questions and answer during the session. Then you can watch the recording. Of course, ideally, join me. Don't leave me alone, guys. Especially on the weekend, it's very nice to get together. And then on Sunday we'll go over top. Okay, so more stuff related to the platform. So see you in those sessions, guys. Keep up the good work. It's great to be part of these sessions. Great questions today, guys. We've been busy with management. I always feel bad when we don't add trades, but realistically, managing the trade is just as important as getting the trades in. So happy with what we've done, and very happy with your interaction on the chat box. Keep it up for future sessions, guys. That's the way to do it. Okay, so this is great. It also shows that you guys are practicing it. So way to go. You guys take care. See you soon. Bye, everyone. Take care.